Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So when you think about long straddles, let's go on in and actually pull up a long straddle. I'm going to go on into here. Oops. I'm going to pull up using the TradeKing profit and loss graph. Let's pull up a long straddle. And let's look at, I'm not going to pick any particular stock in general. It's not intended to be a recommendation at all, but let's just go in and let's go IBM and let's pull up let's go October contracts in IBM, and we're going to, how we'd add them, this is our chain. We got the calls on this side, we got the puts on this side. We got 32 days to expiration, and we're going to buy this one, we're going to buy that one. We're going to add that to the calculator. Okay, that's what our long straddle looks like right now. Now, let's pay attention to the Greeks, though, and let's look at how the Greeks are working. We're not quite at the money, which is going to throw off our Greek. Let's see, let's plot it right at the money. And then we'll hit calculate, and then that should affect our Greeks here. But if I look at this, to start off with, I have a very low net delta as the underlying moves. I'm buying one of the call, and I'm buying one of the put. Now, over here, this is worth noting. When we look at this, the delta of the call option here is 51, not 0.51. And this is actually addresses delta neutral, in that if it's 0.51, that is the delta for the option. But since we are doing one option contract, and that represents 100 shares, this delta is actually displayed as 51, not 0.51. As a matter of fact, if I do this 2 by 2, all right, you will see these deltas double because we are buying two contracts, so it's 200 times 0.51. All right, well, let's make things simple and let's go back to this, all right? Now this net delta is calculated, the combined number is right here. So now as we go deeper and deeper in the money, and we'll even bring that up, let's move the stock a little bit here. And as we move, let's say the stock goes up, let's plot it over here. Let's go, stock goes to 121, and we plot that point. Our net delta on our position is now 12. That means if the stock moves $1, our option contract, our position will only make $12 when you look at it on a position basis. And gamma right here is only 9, which is saying that on the next point movement, we only expect delta to actually go up another 9 points, which will translate to our position of the delta increasing $9. So let's do that again. Click again. Go to 122. And now we notice that now our position acts for every dollar movement up, we only make $21. Now look at the Greeks here. This put, even though we've already had this thing move $2 in our favor, in this instance, the put delta is still at negative 39. That means for every point movement up, that hurts our put, and our put loses 39 deltas, and our call only gains 60 deltas. All right. Now let's go back to the same scenario and let's look at a near-term option. Let's plot it right at 120, and let's go and move the days to expiration to that final week. As a matter of fact, this week a lot of times is called gamma week. All right? So now let's move at 1 point and see what happens to our delta with 1 point remaining. Right then, in a 1 point movement, we saw our delta went to 26, and our gamma went to 24. That means in the next point movement, we're going to really get something here. And if we move to 22, and we hit plot, now we see the delta's already at 50 in this instance, and we just had a 2-point movement on the stock. What was it before? Maybe 20 at that moment. This shows you the explosiveness, and this is what I want when I'm doing long straddles. I need my long call to get to 1 delta as fast as possible in order, if I'm right and the call is going up. Now, Theta is a much bigger number in that it's $24 here, but when I look at a straddle and I'm thinking about buying them near term, I'm not thinking about Theta. I'm thinking this is either all or none. If I pay $3 for a near-term straddle, I'm thinking I am either going to get this thing to move $3 or I'm not. And if it doesn't, hopefully it'll move 1 or 2, and I'll at least get out and be able to salvage some of the premium that I paid for it. And this is actually a reason why I'd rather do long straddles than strangles. On a long straddle, we looked at the stock was right at 120. What are the odds that it's going to stay right at 120 after this big news event? Right? You should hopefully it'll move at least 1 in either direction in the case of IBM here. All right? So I know that I'm not going to get out exactly, I'd be extremely unlucky for that thing to go out right at expiration, right at 120, and I'd lose my entire investment. Okay. Gamma versus theta. It's what traders are always battling with. And also, let's think about the reverse. We're talking about the long side. We like gamma on the long side. But let's think about gamma when you're short an option contract. You've sold a call spread and the market's moving with you. You sold a put spread and the market's going down and going against you. Or you've just sold an option in general, naked. I've sold a naked call or I've sold a naked put. I very rarely have seen any market makers ever remain naked an option contract, a call or a put, in the last week to expiration. But you say, Brian, you just showed me this chart over here. And let's go on in and what do I got to do? F11, I got to move this thing. You just showed me this chart right here of time decay. And if I'm selling options, look at where I get the most bang for my buck. Yes, you do get a lot of bang for the buck, but is the risk worth it? Because if it moves in the money and you're in that last week to expiration or last 2 weeks, that option contract is going to go against you twice as fast as an option contract is out in this range. So bottom line is, option sellers very rarely stay in these positions, albeit even a credit call spread or a credit put spread within the last week to expiration. If it's anywhere close, they have a tendency to get out. I know you always want to squeeze out that last dime. Oh, I don't want to pay commissions to close the trade. But a lot of people don't understand how much risk they're taking on because of this Greek called gamma and how explosive it makes your delta when it becomes in the money. All right. So, I got to take a little drink of water here. Now, the last Greek that I want to talk about is actually Vega. Vega is the volatility Greek, and it tells you how much an option's theoretical price will change for a corresponding 1-point change in the implied volatility of the option contract. The more time premium, the higher the Vega is for an option. Oh, by the way, I said that I kind of like long straddles. I should probably show this up here. I actually looked at option chains and volatility charts. Look at what has happened to the volatility. And actually, I did a seminar. My first seminar that I did for the ISE was back on trading the currency options during a very volatile time. And implied volatilities were enormous. As a matter of fact, that was probably a year ago. And if I pull up a 1-year chart on vol, you can see it was trading 25, 30, right in that range for a long period of time. So we tried to do butterflies to take advantage of that, and that was the theme of the webcast if you want to go back and look at it. But in this day and age, we're at very low volatility.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.